Hi, welcome to Let's Talk Bonds, the fortnightly podcast from INR Bonds. I'm Arjun Patsarthi. And central banks have effectively kept short term yields higher for the next 1 year. With recent meetings of the Fed and the RBI clearly showing the path that to where the yields are going to be for the next 1 year. Investors can expect that the returns on short term bonds can be higher for the next 1 year, while on the long-term bonds, in returns as in short-term bonds, as in the yields on short-term bonds to be higher for the next 1 year. Whereas for long-term bonds, which are already come down in yields and prices have gained substantially, there could be some kind of range-bound trading till the next direction comes from for the bond yields. A lot of movements have been happening in the last couple of months. In the US, the Fed officials have clearly come and said that they will want inflation to stay at 2% levels for the at least 6 months before they take any decision on rates or reducing rates. And the data itself has come in slightly above expectations in terms of inflation data. Both CPI and PMI data have come in higher. And all these are putting pressure on bond yields. US 10-year Treasury yields have risen from below 4% to closer to 4.3% now, while short-term yields are still well over 5% and above. And this status quo is likely to continue for a while, given that so many uncertainties persist and central bank not at all in a hurry to reduce rates. In India too, the RBI has in its policy said that they would like inflation to come down to 4% and stay there for a while so that it gets anchored before they take any call on rates. And the target for CPI headline in CPI inflation is 4.5% in the next 1 year, next fiscal year. And while core inflation has come down, which has been very sticky at over 6%, it's come down to closer to 4% levels now, which is a good sign. But then RBI would like the headline inflations also to stay at 4% because the headline inflations can also lead to increase in core inflation. So all this put together, there been a very nice rally in bonds from highs, both in the US and India. In the US, the 10-year Treasury yield has come down from closer to 5% levels to 4% levels, anticipating a Fed rate cut this year, but that doesn't seem to be happening. While in India, a lot of positive for long-term government bonds. One is that very clearly the government came and said that budget deficit is coming down and the borrowing is more or less stable for this fiscal year. And a lot of demand coming in from sources, especially through the adding of India in the emerging markets bond index. So that excess demand and the growth in the domestic demand itself is likely to keep the long-term bond yields lower. But having said that, the short-term rates are still very high. So classically, what we call in the bond market as a flat to inverted yield curve. The status quo is expected to continue for a while. So in corporate bonds as well, short-term rates are high. We have 3-month CPs well over 8% for the top-rated issuers. And because liquidity is becoming scarce till going into end of March to the financial year end. And this is forcing issuers who are looking to shore up their liquidity towards the end of the financial year to pay higher levels for their borrowings. And while this could ease in April, but not by too much because of the fact that RBI will keep rates steady and also keep liquidity in a deficit mode, which is in a tight mode rather than letting it loose. Because there are a lot of other factors to look out for. One is monsoons, then the political, then you have the elections are coming up in India, then you have the budget after the elections, which is the full budget for the year. So all that RBI would watch out for before at least taking a call on changing status quo. So what does this mean for bond investors? Clearly that the best, if they to protect on a reinvestment risk for a longer period of time, the best bonds would be government bonds. And to take advantage of the higher yields offered in the short-term bonds, look at fundamentally good bonds to invest in for get an extra return that these bonds are offering in a short like 1 to 2 year or maximum 3 year kind of a space. So this status quo is expected to continue, and unless some external factors or something else comes up to change the status quo, yeah, we should be in the same mode as we go along. INR bonds is giving you all the necessary information and price discovery to check the bonds that you want to invest in. You can invest in government bonds, the corporate bonds, and commercial papers and certificate of deposits through a fully digitalized platform with the easiest of settlement processes, where investors do not have any kind of a settlement risk, as they only deal with the clearing corporation of exchanges. Bonds do carry default risk, so investors are requested to read all the details of the bonds and offer documents carefully before investing in. And INR bonds is partnering with financial advisors to make sure that they get the best portfolios for their clients for the bond investments. All this through a very strong data analytics and price information and other information that advisors need to advise their clients on bonds. And we have a partner portal where advisors can easily log in and transact for their clients on INR Bonds platform. INR Bonds is a SEBI registered online bond platform provider. Thank you very much for listening in, and do follow us on all podcast channels.